You work, you save, you hit 2 million, and you think you've made it. But here's the truth. 2 million isn't the finish line. It's the trigger for an entirely different game. And if you play it with the same rules that got you here, you could risk everything you built. Because the strategies that grew your wealth, they may be the very ones that could erode it in retirement. In today's video, we're going to break down why everything changes the moment you cross that 2 million mark, and what you actually need to do next. I'm Josh Evans. I'm a certified financial planner professional, and I'm the founder of Telos Strategic Wealth. I've helped hundreds of pre-retirees cross into this next tier of wealth. And if there's one thing I've seen, it's that hitting this milestone doesn't mean the work is done. It just means that the strategy needs to change. That's why, in this video, I'm going to show you why your withdrawal strategy must evolve the moment you hit 2 million, what tax cliffs and portfolio adjustments you absolutely cannot ignore, and how to reframe your thinking from "do I have enough" to "am I using it right?" So stay tuned for that later in the video. Let's get into it. At 2 million, the typical 3.5% or 4% withdrawal rate generates $70,000 to $80,000 per year. At 2 Social Security incomes, you're now looking at $120,000 to $150,000 of annual spendable income. So let's model it. A 4% withdrawal on 2 million equals $80,000. At $36,000 per spouse in Social Security, that would bring it to $152,000 in total income. That feels like abundance, but now let's see how that income affects your tax exposure and healthcare premiums. Here's a common mistake: believing the 4% rule guarantees lifetime income. It doesn't. It's a rule of thumb, not a law of nature. Market timing, spending shocks, and taxes all influence that outcome. At this level, sequencer returns risk no longer is life-threatening, but it is disruptive. One early market dip can create withdrawal drag for years if your income isn't structured right. Many believe sequence risk is only dangerous below $1 million, or that it's solved after 5 years. Both are false. It's mitigated, not eliminated. Without a structured income approach, retirees often underspend out of caution or overspend and misjudge longevity risk. Both can create challenges in maintaining a sustainable plan. At $2 million, you're probably in the 22% bracket. That's the planning sweet spot, but also the tax trap zone. Why? Because Roth conversions can easily push you into IRMA, the 24% bracket, or the 3.8% net investment income tax. Imagine you convert $100,000. If you're married filing jointly with $120,000 of income, that conversion pushes MAGI to $220,000, triggering IRMA premiums. That would be another $1,000 per year per person for Medicare Part B and D. Over 10 years, that could cost a couple $20,000 in avoidable surcharges. These are dollars you could have used elsewhere. This is where conversions must shift from smart idea to surgical execution. The margin for error is razor thin, especially if you're already taking Social Security or RMDs. And here's another mistake I see often: converting large Roth amounts without accounting for the ripple effect on Medicare and tax credits. It's not just about what you save in taxes, it's about what you accidentally lose. Let's break down how timing matters. Say you start conversions at 62 versus waiting until 67. Starting earlier can allow a smaller, more manageable conversion while delaying Social Security and keeping MAGI low. Waiting until 67 might force larger conversions right when RMDs and IRMA hit, and this reduces your flexibility. Do you convert now to avoid future RMDs, or defer to preserve tax flexibility? The right answer depends on withdrawal timing, age gaps, and Medicare strategy. Many think Roth conversions are always better. That's like saying gas is better than electric without knowing what you're driving. This example is educational and may not reflect your unique situation. Roth conversions involve many variables, so it's essential to work with a financial professional to determine if this is the right move for you. Now, if you're watching this and realizing your $2 million strategy needs fine-tuning, you're not alone. I help people transition to this stage every single week. And if you want to know exactly how to apply this to your life, your numbers, and your priorities, click the link in the description to book a call with me. Now, at this level, you don't need 7% returns. You only need 3.5% real to make the plan work. Yet, many portfolios still chase growth like they did at 500,000. Let's look at how portfolio construction changes. Portfolio A is a 60-40 mix. The return expectation, let's say 5.5%, moderate risk. Portfolio B is a 50-50, and that returns, let's say 4.5%, smoother ride. Portfolio C is a 40-60. This is return 3.5%, income-focused stability. What happens when markets drop 20% early in retirement? Portfolio A may recover faster but could trigger emotional reactions. Portfolio B and C, they could reduce drawdown depth and behavioral risk. The cost of volatility is far greater than the benefit of extra return. At $2 million, the biggest threat isn't underperformance, it's emotional reaction to drawdowns. Here's the next mistake: using the same aggressive portfolio you had while building wealth. Accumulation strategy doesn't always equal distribution strategy. Do you chase alpha and risk-forced selling, or adjust to preservation mindset and gain stability? Keep in mind, alpha measures the difference between a portfolio's actual returns and its expected performance, given its level of risk as measured by beta, which is measured volatility relative to its benchmark. A positive or negative alpha indicates the portfolio has performed better or worse than its beta would predict. If you're still in accumulation mode, downturns can feel like setbacks, but at $2 million, you don't have to win anymore. You have to protect the lead. Many struggle to shift from growth identity into income stability. It feels like giving up, when in fact it's leveling up. At $2 million, the core question is no longer, do I have enough? It becomes, how do I use this well? That's a mindset shift most aren't prepared for. And that opens up a new set of questions. Questions like, can I start gifting to kids or causes? Should I retire early or travel more? What legacy am I actually trying to leave? And should I convert or should I spend my Roth? More money creates more options and sometimes more confusion. Without structure, retirees can feel paralyzed by the pressure to get it right. This is why people think hitting $2 million gives clarity. Often, it adds complexity. And here's the next mistake: not revisiting your estate documents or beneficiary designations after reaching this level. At $2 million or more, tax exposure and legacy complexity both increase. This is where I introduce our 4-step retirement philosophy. It's our framework we use to simplify and guide the entire process. We start with an introduction by understanding you, your lifestyle, your values, and what retirement really looks like to you. Then we move on to discovery. In this meeting, we dive deep into your financial picture, we clarify your goals, and we uncover any blind spots or opportunities. Next, we present. We deliver a personalized set of recommendations aligned with your needs, priorities, and long-term vision. And then we implement those. We ensure everything gets executed properly, working alongside you so your plan becomes reality and not theory. Without clarity, retirees drift. They hold too much cash, delay spending, or they hoard it unnecessarily. Suddenly, the very money they work for becomes a source of anxiety. And I see it often with people $2 million or more who feel less peace than they did at $1 million. That can happen when confidence doesn't keep pace with complexity. Before we close, I want to walk through one more thing that most retirees never expect: the identity shift. You've spent 30 years building wealth, watching your balances grow. Now retirement flips that upside down. You're not spending, you're drawing down, and that can feel wrong. Why is it so hard to spend what you saved? Because your brain sees depletion as loss. Why do most retirees need permission to enjoy their money? Because without a plan, guilt can creep in. Behavioral traps such as fear-based cash hoarding, second-guessing big purchases, or refusing to take that dream trip can kick in. And this shift is emotional, not financial. If you don't address it, it will sabotage your retirement. So here's a quick checklist to keep it simple. Know your brackets, IRMA, income, capital gains, and your Roth strategy. Secure the income you need so the rest can flex. Define your musts, your wants, and what legacy matters most to you. So we've seen how the $2 million milestone doesn't just change your bank balance, it changes the entire way you need to approach retirement. From safer withdrawal rates, tax planning to portfolio shifts, and new psychological questions, this phase can demand a different level of clarity and precision. You now understand the technical shifts, but the knowledge alone won't build a plan for you. Because knowing that IRMA thresholds exist, or that your portfolio needs rebalancing, doesn't mean you've built a retirement income strategy that actually works for you. That's the next step, tailoring this to your specific needs. The truth is, most retirees stay in accumulation mode far too long, and that creates missed tax windows, unnecessary stress, and often oversaving at the cost of lifestyle. If you've crossed $2 million, or you're getting close, now's the time to switch gears. And that's exactly what I help people do every single week. So if you want to know how this applies to your numbers, your lifestyle, and your decisions, click the link in the description and let's build a strategy that works for you together. Thanks for watching, and I'll see you in the next video.